Good day folks, Jim here from Orchard Forex. It is Saturday the 10th of October. Markets finished the week on a positive note with risk associated assets ending higher as hopes grow that a COVID-inspired stimulus package in the US will be put together, which Donald Trump will obviously be hoping arrives ahead of the election on the 3rd of November. That remains to be seen, but on Friday the markets liked a Wall Street Journal article hinting at such a possibility, sending stock markets higher and the US dollar lower on all fronts. And in the short term the charts do look positive, although it is a US holiday on Monday, so it could be a bit of a sideways session. But as long as there's no turnaround in sentiment, then markets do look like staying positive to me. If there is no progress with the election now just being 3 weeks away, we can probably expect a sharp turnaround in sentiment. But for the time being, buying risk assets does seem to be the plan, although with the President's Twitter account seemingly running the election campaign, I guess we should be prepared for anything. But in the meantime, we'll go and have a look at the charts, and we'll start as usual with the euro. So here we have a 4-hour chart of the euro against the US dollar, and I had been quite negative on it, thinking that the head and shoulders that I thought we were forming here might see further downside momentum. That hasn't occurred, and the week has seen the euro actually close on a recent high, about a 3 or 4 week high, back above the neckline, which is now at 118. And with the short-term charts pointing higher, the hourlies as well, it looks to me as though we are going to see further upside progress in the euro. And as I say, as long as risk sentiment remains positive, it looks to me as though we're going to be heading towards this sort of 118, 55, 60 area, and above here to 118, 70, 75. And if we go and actually have a look at the Ichimoku chart, we can see here on the daily Ichimoku that the top of the cloud comes in. It's around 118.70, so that's going to be pretty decent resistance. But beyond there, I think we can probably look at 119, go back and look at the hourlies. So here we have 61.8% of this whole move down from above 120. That comes in at 118.5. And then above this 118.70 level, which I point out being the cloud, this the 76.4 level, which equates to this previous high here back in early September, that comes in around 119.15. So I kind of think that's probably the direction of it for now. But if we do see, going back to the 4-hour charts, if we do see a break back below the neckline here, then I think once again we probably head back towards 117, 116.80, something like that. But right now that doesn't look to be the case. So I think on the day, as I say, it's a US holiday, so it'll probably be quiet. But buying dips towards 117.80, 118 with a stop loss below 117.5 would be my plan. All this is outlined on the website. If you go to orchardforex.com, the daily blog article, it's all outlined there, so you can see for yourself. But moving along to sterling, that's quite interesting too. Now here we have a 4-hour chart of sterling. Cable's pretty hard to trade at the moment. There's too many Brexit headlines coming out, but for the time being, it looks to me as though we might have a bit of a reverse head and shoulder here. We've broken above this neckline and we're back above 130, and the measured target from the low to the neckline is around 133.30. So I think maybe target that. There's various FIBO resistances in between. They're outlined, as I say, on the website. But as long as we stay above sort of 129.70 today, I think we probably can look to buy dips, and as I say, if we can make headway beyond here, then 133 plus. If we were to go back down here, 129, I'd probably still look to buy it again, because the trend, we're making a series of higher highs. But it's certainly, if we were to make a move below 129, I'd be straight out of it. The 4-hour charts do seem to be moving a little bit higher. The dailies also kind of have some mild upside momentum. Although, as we can see, if I blow this up, we're stuck here near the 55-day moving average. We've actually closed above it, so that might provide added momentum for the next move higher. The Aussie and the Kiwi both had good sessions on Friday, and the Aussie's come up here to downtrend resistance going back to sort of mid-August, late August, sometime like that. If we can get above this sort of 72.5, 72.55 area where we've got some FIBO resistance, 61.8% of this move down, then I guess we can head back towards 173, sorry, 0.73, and possibly this to the 76.4 level at 73.15. But this 61.8% level, a bit hard to see here, but that's at 72.50. So we've got to get above that yet, above this resistance, but the direction seems to be higher. The daily charts are not doing an awful lot, but they are beginning to point a little bit higher. Going back to the 4 hours on the downside, I guess today we'd be looking to buy it at around 72 cents with a stop loss today probably placed somewhere around sort of 71.80, 71.70, somewhere around there, I think. And moving forward, I won't go any more into currencies, but we'll go and have a look at some of the stock markets. Okay, so here we have a 4-hour chart of the S&P. Now we've closed at 34 3/4, and the next FIBO level looks to be at sort of 34.95 up here at 76.4, and as long as risk sentiment remains positive, I think it's very likely we're going to test that, beyond which we go back to sort of 3,500, and then we've got the all-time high here at this sort of 35.85 level. I'm not sure we're going to see that early in the week, but the 4-hour indicators do look to be pointing higher. The dailies are pretty neutral, but if anything, they've got mild positive momentum behind them. So, as I say, as long as risk sentiment remains positive, I think we need to be looking to buy dips. On the downside, there is some minor support at this 34.20 area, and then again at around 3,400. And the 100-day moving average comes in here around 32.70. That's a long way off at the moment. And as I say, if anything, I'd still be looking to buy dips. The weekly charts, they are overbought, but they seem to be pointing higher again for the time being. And I think while we head to the US election, I think stocks are likely to remain underpinned. And then it all depends on the outcome of that. Although I do notice the Bank of America are suggesting that a Democrat win would not hurt stock markets so much because of the amount of stimulus that they would be required to pump into the market. While we're here, we'll have a quick look at the Aussie market, which is relatively interesting at the moment. It hasn't really done an awful lot for quite a long time, really, since sort of March, April, and it's done this sideways tracking. But we are coming up against, we've actually closed right on the 61.8% level of the whole fall. We're up against this resistance here, having carved out this sideways channel. But if we can take that out, then I think we're possibly looking at a retest of these highs back here, sort of 6,200. And beyond there's not an awful lot really until sort of 64.50. So it's worth keeping an eye on. Obviously, we've had our own stimulus package from the federal budget last week, and so that should underpin the market. But if stock markets do turn lower, then we're going to head back into this channel. But for the time being, I kind of think we might give this a serious test on the top side. And if we can take out 61.50, then I think 6,200 is probably not so far away. Moving along to gold, and that has broken above the 2 months or downtrend resistance and closed back at 1930, which is also back above the previous all-time high set back in 2011 at 1921. So the 4-hour charts look positive. The dailies seem to be building some higher momentum, although it should be noticed that the weekly charts are still correcting lower, having become quite overbought above 2,000. So for the meantime, though, I kind of like the idea of buying dips. If we go back below 1900, I think I'd be out of it again, though, because a move back below 1900 could quickly take us back to this 1875 level, and possibly even back to 1850. But while the risk mood remains positive, the US dollar is going to remain under pressure, so gold or commodities in general will reprice themselves, and I kind of think the upside is the way to go. As far as targets are concerned, we need really to get above this 1935 area relatively soon, but beyond there we can go back to this sort of 1960 and then 1990 area. So that's kind of my way of thinking for the time being. Before we finish, we're just going to have a quick look at the calendar. Okay, so far as the calendar is concerned, Monday might be a bit of a write-off because it's the US Columbus Day holiday, but Tuesday's going to be busy. We start off with the Chinese trade balance, and then later in the day we've got the UK unemployment, which will be followed by the German CPI, the US CPI, and also the ZEW survey. So that's going to be a fairly busy day. Wednesday sees not a lot of economic activity, although there are various ECB speakers, central bank speakers. We've got Lagarde primarily, I guess. Lane and Mersch are also speaking. Then on Thursday we've got the RBA governor speaking. Philip Lowe will be speaking early in the session. That's ahead of the Australian unemployment and the Chinese inflation data, so it might be a fairly busy day for the Aussie. Later in the day we've got various bits and pieces of secondary US data, and then on Friday we've got the US presidential debate as well as an IMF meeting, but it'll be the presidential debate that takes all the headlines, and that's if that takes place. At the moment I'm not sure it's going to, but later in the day we've got the US retail sales. And then we've got the usual, the secondary build-up. We've got the industrial production, capital utilisation, business inventories, and the Michigan consumer sentiment. So that'll be about it for the calendar this week. It could be fairly choppy, but I think buying risk assets on dips is possibly the way to go. But I'll be leaving a fairly tight stop loss on most things, because if the negotiations fall apart with regard to the COVID stimulus, then all bets are off as far as positive risk sentiment goes. So good luck with your trading. As I say, if you want to read some more, it's all on the website at orchardforex.com. But I'll be back with another video next week. Cheers.